Hi, this is Clarke with Market Perspectives halfway through the year. The goal of today's update is to kind of share where we sit at the end of Q2. It's been a productive year for the most part. We've seen the large cap market as represented by the S&P 500 up about 8%. The Dow Jones is up a little bit more than that, kind of speaking to the rotation we're seeing in the market a bit. It's up slightly less than 9%. The interesting factors, and we've kind of talked about diversification in previous sessions, diversification is paying off in a big way. In fact, we're seeing one of the best years small caps have had in a very long time. In fact, at that point, the Russell 2000 has been positive about 22% this year. In addition to that, we're seeing emerging markets perform quite well, also up in the low 20% so far this year. International markets, developed markets, as we typically call them, it's typically measured by EFA, Europe, Australia, Far East, tracked often by Morgan Stanley. That's up about 10% this year. So they're kind of running in line with our large cap US indices. And somewhat of a disappointment, but not surprising. Bonds have underperformed this year. Year to date, so far, they're up about 1%. A little bit more for corporates if you just sort of narrow out that section of the bond market. But the Barclays aggregate is up about 1% so far this year. Again, why is that not surprising? Well, Kevin Warsh came into an economy that has a fair bit of inflation. And I think many of us have felt these price increases across the board. The good news, though, is even though the Fed is not necessarily able to cut interest rates immediately, we do see future rate cuts and anticipate those. Maybe one towards the end of the year, and I emphasize maybe. I think we're likely to see more of a sustained rate cut as long as inflation is kept in check starting next year. What's kind of interesting, and I implied earlier with the rotation, is tech isn't driving the market indices as much as it has in previous years, even earlier this year. It's kind of hard to remember, but in March, we saw a very weak market. Technology, in fact, led the market lower. And technology continues to kind of dig its way out of the depths that were established in March. To the point right now, the Russell 1000 Growth Index is up about 1% for the year, whereas the Russell 1000 Value Index is up 16% so far this year. The equal weight S&P, so you take all 500 companies, equally weight them, as opposed to a cap-weighted index, which clearly where technology has prominent positions, is actually exceeding the S&P 500 cap weight by 500 basis points, or about 5%. So it speaks to that rotation that we're witnessing and a broadening of the market that, again, we have been anticipating. So even though there's been a lot of news about technology, we understand that we're amidst an enormous evolution from an artificial intelligence standpoint. We continue to see that some of the old sort of plain companies, the normal companies in the US, are actually performing quite well. So as we sit halfway through the year, sort of looking at the sectors that have performed well, energy's been one of the best performing areas. No surprise there. The Iran conflict or war has obviously caused the cost of oil to go up considerably. Thankfully, in recent weeks, oil has trended closer to about $70 a barrel. It was hovering, as we know, between $90 and $100 a barrel, which is very inflationary and problematic for the economy because it affects the consumer, obviously. It affects the prices of everything that we buy. Ranking second in terms of what's been performing well sector-wise has been industrials. And I think part of that has to play out with them lagging for a while, but also being part and parcel of this AI build-out. And then coming in third, but not too far behind at about 14% so far this year, is technology. The Mag 7, which has kind of been recently referred to as the Lag 7, has been struggling. These are the prominent companies that drive the S&P 500, or have driven rather the S&P 500 going back several years. So far this year, companies like Microsoft, they were down 17% just last month in June. Amazon is up about only 3% for the year to date. It's lagging the S&P 500, where frankly, in the past, it's actually been a huge contributor to the S&P 500's total return. Apple down 7% in June. So technology is taking a little bit of break. We are seeing some consolidation in that area. But we're also, again, seeing other parts of the market step in and kind of taking some of that slack up. So going forward, we're not, I would say I feel lukewarm about the prospects of the market. I'm not negative, nor am I overly optimistic. I think we're dealing with an inflationary situation that has tied the hands of the Fed. Oil, again, with its recent trending, has been helpful in terms of its contributions or its impact towards CPI and towards inflation. But it seems like the war is coming to a potential conclusion. At least we certainly hope that's the case, which should continue to push oil prices lower. I think earnings has been the surprise factor here. This is a market that has not been driven by the economy performing well as much as it has been companies actually meeting their numbers, growing their revenue and bringing it to the bottom line. Earnings have been decent. And as we roll into earnings season here in the end of Q2, we anticipate actually some decent numbers. We'll have to see what guidance provides. If there's going to be weakness this year, we probably will see it here in the third quarter. That's typically when it manifests itself. And then frequently, and I know it sounds sort of like a generalization, but fourth quarters often perform reasonably well. So in summary, again, we've spoken about the benefits of diversification. We're disciples of, obviously, of asset allocation and making sure that we're properly weighted across different areas of the market. That hasn't changed one bit. In fact, in highlighting some of the areas that we're somewhat surprised in terms of how they performed, the absence of that exposure of those weights would have been detrimental to overall return. So we're going to continue to stay well diversified. We're going to make sure that we don't have too much concentrations in certain areas. We're optimistic on artificial intelligence, but we're not interested in being overly exposed to artificial intelligence companies. This is Sean Clarke. This was Market Perspectives. Thank you for your time.